Alright, what's up guys? I hope you're doing well. James here from jamesforsythe.com. With the recent sell-off in bonds, I really wanted to get on here and kind of talk and look at kind of, I guess, the behavior of bonds from a historical perspective, because I'm not exactly, haven't been into bonds for a very long time or the fixed income market in general, but it's something that's been kind of piquing my interest recently because I've always enjoyed are that's kind of what I always look for is things that are starting to turn out of favor or whatever. And also just the arguments and the nuances of the fixed income market I find very interesting. Right? It can be rather complex when you dig into the weeds, and I just love that sort of thing for some reason. But anyways, straight to the point, I found an article, or well, I guess technically a blog post on the New York Fed's blog, Liberty Street Economics, about the actual sell-off and kind of comparing it historically, which is another thing that I always enjoy is really trying to put things in context and like how does this compare to things that have happened in the past already, right? And so with that said, we're gonna hop right over there and make sure that it's up and running. Good. Okay. And so treasury yields have risen sharply in recent months. The yield on most recently wow, I just can't talk today for some reason. So the yield on the most recently issued 10-year note, for example, rose from 1.73% on March 4th to 3.48% on June 14th. So that's almost double, reaching its highest level since April of 2011. So increasing yields result in realized or mark-to-market losses for fixed income investors because that's how fixed income works. And so the higher the yield, the lower the price, um, especially as they increase. So there's that because when there's more demand for for specific bonds and there's more buying, the yields go down. Um, so in this specific post, they're basically talking about losses in a historical perspective, which is pretty much what I'm interested in, and investigate whether the long-term yield changes are better explained by expectations of higher short-term rates or by investors demanding greater compensation for holding treasuries, right? And at the very end, we'll get into kind of some of the reasonings and just how long they think it'll take for um, these losses that have already happened in just this past few months to be recouped, right? And so this chart here shows the returns based on a 10-year, and this says zero coupon yield. And so basically ignoring the coupon and just looking strictly at the price of the bond. Um, so it's down 12.4% for the 2-month period, which ended in May 5th. And then one thing to keep in mind is that all yields and returns in this entire post are all nominal, so no inflation accounted for. But you can incorporate that in if you want. So the decline is the largest since August of 2003, which was 14.6%, and April of 1994, which was negative 13%. And so you can kind of see that here, where we have May of 2022, but at negative 12.4, and you can see how it kind of compares. Where it wasn't really till the 70s where we saw one that was significantly lower, right? All of these are kind of relatively the same, plus or minus a couple percentage points. But this one where it looked like it got well into the 20s, right? And so how are they really defining these sell-offs is kind of important. And it gets kind of I kind of want to just use their exact words, just so it's easier to. I don't want to butcher it too much on how exactly they're defining it. And so, because the length of a bond market sell-off may be shorter or longer than 2 months, which is what they stated before, um, for these are 2-month sell-offs, and so they adopt a flexible approach to defining these. The first, the cumulative, they accumulate returns for a hypothetical 10-year zero coupon treasury security. Basically, this is all from August 1971, which I thought was pretty interesting and pretty ironic for a date. Not 100%. I guess it kind of makes sense because that's when Nixon took the dollar off the gold standard was August 1971, and so I'm assuming it's with all the kind of treasury stuff that was lumped back in there historically. And so identifying each time cumulative returns reach a maximum for the period to date. They then go through the data a second time, accumulating returns from the maximum to date. Whenever a cumulative return drops down below the maximum, we sell. They say it's a sell off has started, and then basically when it reaches a new maximum, it's recovered because they've recovered all their losses. Basically, every time a sell off becomes trying to word it and not butcher it. So basically, the price increases, and then you have general sell off, right? And they basically count the time of the beginning of the sell off all the way until the prices get back to the original peak, so to speak, and break it. That's the end of the sell off, right? And so that's kind of how they're defining it. And so they do multiple. They did this for all the way back into the late '70s, I believe, or I mean early '70s. And they found, I think it was 42 sell-offs. Yeah, they identify 42 sell-offs in which that drop was more than 5%, and then the average loss was 11.1, and the worst was 38.4, which was between June of 1980 and August of 1982. And they also looked at the length of these sell-offs in general. And so the average length of these sell-offs were 214 days, trading days. The minimum was 21, and the maximum was 722, right? And so this chart down here plots the sell-off, showing the current one is the largest in 40 years, which exceeds those seen in 1994, 2003, and 2013. As of publication date, the trough of the current sell-off occurred in June 14th, with the cumulative return being 26.9%, which we see here for June 2022. And it wasn't this is the negative 38.4, I believe, in 1982. And so you can see how it kind of compares in total, right? And so this is the largest one in the past 40 years, and unless it actually breaks this, if unless it corrects by almost 40%, then it's um, I don't know how far back it goes. I don't even know if they started collecting data on this in the 1971 or before 1971, or how they're defining that specifically, right? And so basically, they're charting the cumulative returns and comparing them historically now. And so they're showing this dark blue one is currently, and then you have historical 10th percentile, median, and then the 90th percentile. And so you can kind of see how it compares and how currently, from the, in terms of the number of days since the start of sell off, the current one is by far the worst of these. And keep in mind that percentiles, and so we're not talking about just specific ones. There's a sort of average in there, right? And so one thing to keep in mind is like with the historical 10th percentile, you got these big drops in like 175 to 350 days out, which are lower than the one than where they are currently. So just because it's this low doesn't mean it can come back up. And also keep in mind, as we'll get into with this graph here, that it kind of has to come back up to end to begin with. That's how they define it themselves, and that's why you have the top of this chart actually beginning at zero, and that's how they're defining the end of the sell-off is when it basically comes all the way back up to zero. And so we see basically the current one has possibly bottomed, um, may or may not, but it's pretty relatively close to the lowest it's been since its beginning. So keeping that in mind. So pretty much they attribute this to rising term premium for all of these, which from my understanding is basically the premium investors place on the bonds to hold them to a specific term, right? At least from my understanding. And that's pretty much what they're attributing it to. And they also had have another post from almost a decade ago, which I'll probably go over in the next few days, just kind of going further in depth because it looks very similar, right? And so here we kind of show the difference between returns based on the raw yields and then the returns based on term premium, right? And so you can kind of see how that compares to um, other times in history. Looking at the same chart as before, where we were looking at returns above, I'll scroll back up to it. This chart is basically just overlaying the term premium. So you can kind of see the times, especially when the returns were for the returns based on the returns based on the term premium um, were actually significantly lower than just raw yields in general, right? And you can kind of see where that's going. And you can't really see the red for the June 2022, so I'm assuming that's going to be it's at the very probably about halfway down or so. So it'll be interesting to see how that plays out in the next couple months. And so basically, comparing them all in general, so most of the sell-offs, including the current one, have a term premium component, albeit one that is appreciably smaller than the sell-off as a whole. In contrast, the 2013 sell-off stands out as having been driven entirely by changes in term premium, right? So it seems like there's different kind of components within the yield in general. And so that's kind of you have to look at all of them to see the overall yield in a way, but they're talking they rank them 1 through 10 here for the largest since 1971, and we see that this one currently seems to be the third largest as of right now, and there's that negative 11.2 we saw earlier, and that's just with respect to term premium, right? So there's that, and basically with all of this, they pretty much deemed that if interest rates and everything stayed the same, and because I mean, you have this sell off, so at some point it kind of has to end. Not because the price itself goes all the way up, but the fact that there's yield to those bonds. So eventually that yield will just continue to chip away at that kind of differential between where the sell off began. Unless you have negative interest rates, I guess, but or at least nominal interest rates, depending how they're defining it. Because again, they're not. The entire blog post is only incorporating nominal yields, right? And so basically, um, excluding if yields didn't increase or decrease or anything, basically just a constant, it would take about 7 years for all those losses to be recaptured from this one sell-off itself, right? So that's just kind of a if the whole reason you're holding it is to, have price appreciation, you're having a very bad day, or I guess m pretty much year, if it's began all the way back in, I think it was March. Yeah, early March. That's 3 months or so. So, yeah, that's definitely a bad time. But anyways, I'm gonna leave that there. Alright, cool. So, yeah, I'm gonna leave that here. So I hope you guys have a good night.